We will now look at an accounting rule that is specific for recording inventory, and the rule is called the lower of cost and net realisable value rule. So for inventory, you have the cost. This is how much you paid to buy the inventory. But you could also find the net realisable value for the inventory. And when you compare these two values, whichever one is lower, that's what should be reported on the balance sheet for the inventory. So let's have a look at some principles about this. The cost principle we looked at in our first week of accounting. And the cost principle relates to recording assets. And we said all assets should be reported at the price you paid for those assets. So that includes inventory. So as an example here, we buy watches to sell in our online shop. Each watch costs $70 to buy, and you buy 100 watches. You're planning to sell these watches to customers for $150. So you've bought an asset that you plan to sell to customers. That's called inventory, and it's increasing. You have spent $700 to buy these watches. It's 70 times 100, and we have accounts payable as well. Now, our prudence principle is the basis for this rule. The prudence principle means that inventory on the statement of financial position should be reported at its net realisable value if this value is lower than the cost. So whichever value is the lowest, the cost or the net realisable value, that's what you need to show on your balance sheet. So what is the net realisable value? You might have noticed how we referred to it here as the market value. The net realisable value is the amount a company gets from selling the inventory in the normal course of business. And that's based on our AASB Australian Accounting Standard 102. So it's like the market value. What could I get today if I sold that inventory? At the end of the year, we realise that customers will not pay $150 to buy our watches. We were hoping to sell them for $150. But because of very intense competition, our customers are not buying our products. So we keep reducing the price, and unfortunately, we find out that our customers will only pay $50 to buy our watches. This is the net realisable value, or the market value. It's how much we could get from selling our inventory in our normal course of business. However, did you notice that when we bought the watches, they cost us $70 to buy, and our customers will only pay $50? This is less than what we paid to buy the watches. So the cost of the watches was $70 each. The net realisable value is $50 each. So based on those 100 watches, the difference is $2,000. So we need to make an adjustment to inventory. What we need to do is to decrease the asset. Originally, when we bought the asset, we recorded it at $7,000. Now I'm going to minus $2,000. So this will show the value for my asset as that $5,000, the net realisable value. The debit is going to be a loss on inventory. This is an expense item because if we can't sell our inventory for more than the cost, then that's cost us a lot of money. That's an expense. Each item of inventory is evaluated separately, and the loss of one inventory item cannot be offset by the gain in another item of inventory.